Recording credit transactions. First, we're going to have a look at the need for source documents. In other words, why on earth do we actually record every transaction that takes place on a little piece of paper? Well, financial statements must be prepared for the people who are interested in the success of the business, the owner, the bank manager, creditors, etc. We already looked at that. These are the stakeholders. And these financial statements need to be prepared based on the actual transactions and obviously need to be as true and accurate as possible. So in order to be able to keep these accurate, we need to use source documents in order to track all the transactions. We're going to use different documents for the different types of transactions that take place. So, for example, we'll use invoices that we issue to customers for all the credit sales, and we will use receipts for all the cash that might be received, etc. Let's first have a look at what an invoice is. An invoice is going to be issued, as I mentioned, when we sell goods on credit specifically, because it indicates that an amount of money is owed for a sale of something. We are going to keep the duplicate for ourselves and issue the original to the other party. It's just polite to give them the original. When we buy goods, we would then receive an original invoice, as the duplicate would be kept by the seller. This is what an invoice could look like. Please keep in mind that your invoices could look very, very different from one business to the next. However, the basic information is going to be the same. So don't look and see if it has the same logo on it. Rather, look and see whether the information is correct, and most importantly, what the name of the document is. You'll see over here it says invoice. You will always have the name of a document on a document, and that tells you what the purpose of the document is. Firstly, you need to have the information of who this document has been issued to. So the person or the business, in this case, to whom the goods or services are being provided. Secondly, you would also need to have the name of the business from whom the goods or services are being received, or the supplier. So over here you can see we have the customer, who would become the debtor or the receivable, and we have the supplier, who would be the creditor or the payable. You would need to show the name of the document, as I've mentioned, and very importantly, the number. The documents are always numbered so that we can track all the different documents and make sure that we haven't lost anything along the way. And it's easy to use in our audit trail later on to be able to see where information has come from and where it's going to. It also helps prevent any fraud or error where you can check that you have got all the document numbers and there's no number missing. You will also need to show the date on which the transaction took place so that you know when it happened. You would need to have all the details of the goods and services that have been supplied, along with the price per item and the quantity. And then you would work out the total value of the transaction, and that will be shown over here. In reality, we will only ever record this total amount in our books. The individual items are not going to be shown in our accounting records other than on the source document. But because we'll keep the source document, it means if we ever want to know, we can refer back to it and we can see all those details. We're then going to take this information and put that into journals. Because businesses have many transactions, it's very often far too difficult and cumbersome to record them directly into the T accounts or rough ledgers that we've looked at so far. Therefore, what we do is we create journals in order to summarize all the similar transactions. Journals are also known as the books of first entry or the books of prime entry, because this is where we record the transactions originally. And it is simply a summary. If we have a look, for example, at the purchases journal, we're going to use this journal for all the credit purchases, and in other words, every single time that we buy something from a supplier on credit and therefore we owe money to them, our trade payables, it means that we're going to increase the liability that we owe to these suppliers, and therefore we can list them all in one place and simply post the total to the supplier's account in the general ledger. So the purchase invoice shows the details of the transaction as we've just seen on the example invoice. In other words, what was bought, how much was owed, the details of the supplier, the terms, in other words, how long you have to pay the supplier, etc. All the credit purchases are recorded in the purchases journal. And you can then post the totals to the individual supplier accounts, which would be credited, as well as the assets or expenses for the items that were bought or the services that were received. That will then be debited. The sales journal is going to be used to summarize all the sales transactions in a very similar way. Remember that all the credit sales to customers will increase the amount owed by those customers to the business, and therefore will increase your trade receivables asset, which must be debited. The sales invoice, just like the purchases invoice, shows what was sold, the amount owed, the customer details, terms, etc. And then all of these can be recorded in the sales journal so that we can then post the total to the individual customer accounts, which will be debited, and to sales, which will be credited as it's an income increasing equity in the general ledger. Sometimes it happens that we are either going to allocate a trade discount to our customers or receive a trade discount from suppliers. A trade discount is generally a discount that is given to retailers or other traders who are going to then sell the product on to somebody else. It could also be a wholesale discount. It's exactly the same thing. It can also be given for bulk purchases if you're buying in very large quantities. The discount will be shown on the invoice, but only the net amount, or the amount after the discount that is actually owed, is the amount that is going to be recorded as your sales or your purchases. To calculate the net amount, you simply take the original amount times the percentage of the discount to get the discount, and then you subtract that from the original amount in order to get the invoice amount. In practice, you would usually just simply read this off the invoice, but sometimes you will have to calculate it yourselves. The last thing that we need to look at is return of goods. It sometimes happens that goods are returned by customers, or we may decide to return our goods to suppliers for a number of reasons. Possibly the goods were damaged, maybe they weren't according to the sample that was given initially, or maybe we just changed our mind, or the item was the wrong size or the wrong color. In this case, what will happen is you need to make an adjustment. Now, you would need to either adjust the invoice if your item or the amount are wrong. Maybe you made an error in creating the invoice, or maybe you forgot a trade discount. So in both of these cases, either where the actual goods are returned or possibly the invoice was incorrect for some reason, in both of these cases, you need to reverse the original transaction by the amount of the return or the error. All you do is look at the original transaction and then do exactly the opposite. So, if we are going to send stuff back to a supplier, we will enter this in a purchaser's returns journal, where we are going to reduce the amount that is owed to the supplier and reduce the amount of the asset or the expense that we bought. Similarly, sales returns from customers, we will enter into a sales returns journal, and then when we post that to the general ledger, we will reduce the amount owed by the customer. In other words, we'll credit the customer's account and we'll debit the sales income account because the sales is less than we expected. I hope this helps you understand the purpose of journals. Make sure you understand it thoroughly before you move on to the next chapter.